Welcome back to AS Gold. In this video, we break down the gold market for the 9th through the 11th of June, 2026. We'll cover the macro calendar, the geopolitical backdrop, the all-important U.S. inflation report, and the key technical levels that matter for gold this week. Let's get into it. Gold comes into the week on the back foot. Spot is trading around $42.90 to $43.25 an ounce, after shedding roughly 4 to nearly 5% last week. That's its lowest level of 2026. But zoom out, and gold is still up about 30% year-on-year. The short-term bias is bearish, but the market is getting oversold. So what dragged gold lower? It started with a stronger-than-expected May jobs report, released on the 5th of June. That revived the higher-for-longer narrative for the Federal Reserve, pushing the dollar and Treasury yields up. And as yields rise, the opportunity cost of holding non-yielding gold rises with them. That's exactly what we saw. Here's the calendar. Tuesday is quiet, with no top-tier U.S. data, so expect positioning ahead of the main event. Wednesday is the big one, May CPI at 8:30 Eastern. Then Thursday brings producer prices and weekly jobless claims, also at 8:30. Note that May payrolls already landed last Friday, and there's no major GDP print this week. Wednesday's inflation report is the hinge for the entire week. Consensus clusters around 4.0 to 4.2% year-on-year, and the Cleveland Fed's nowcast sits near 4.18. A hot print, above expectations, lifts the dollar and pressures gold. A soft print revives rate cut hopes and can spark a sharp relief rally. It's also worth looking just past our window. The Fed meets on the 16th and 17th, a projections meeting with a fresh dot plot. Markets price about an 86% chance of a hold, at 3.5 to 3.75%. And the Fed blackout has begun, so headline risk this week comes from data and geopolitics, not from Fed speakers. Now for the two-sided story. On the bullish side, geopolitics are front and center. The 2026 Iran conflict, with reported strikes on U.S. bases in the Gulf. Fresh U.S.-China tariff headlines add to safe haven demand. Central banks bought around 244 tons in the first quarter, retail bar and coin demand jumped 42%, and sticky 4% inflation keeps the hedging case alive. On the bearish side, those strong May payrolls revived hawkish bets. A firmer dollar and higher yields raised the cost of holding gold. A hot CPI could push rate cuts further out, and the technical momentum is clearly to the downside. A daily close below 42.54 would open the door to deeper losses. Put it together, and you've got a genuine tug-of-war. Hawkish data, the dollar and yields, pulling gold down, against live geopolitical tail risk that can lift it in an instant. Into Wednesday's CPI, the path of least resistance is choppy to lower. But conviction shorts are dangerous here. Gold is oversold and one headline away from a safe haven bid. Onto the technicals. The structure is bearish. Price is trading below its 20-day moving average and VWAP, and the 9-period EMA sits below the 89. That's classic downward momentum. But the RSI is near 29, which is oversold, and warns of relief bounces. The 52-week moving average, around 41.95, is the bigger trend pivot below the market. Here are the levels to trade against. To the upside, first resistance is 43.76, then 44.41 and 45.10. Above that, the ladder runs through 45.77, 46.46, and on toward 4,700. Gold needs to reclaim these to flip the short-term tone. To the downside, the first and most important support is 43.13 to 43.19, the yearly open. Below that sits 42.55, 42.02, and the 52-week average near 41.95. Lose those, and 41.14, 40.060, and 4,000 come into play. If you remember one number this week, make it this, 43.13 to 43.19. That's the yearly open support, the single most important near-term level. Hold it, and gold has a base to bounce from. Lose it on a daily close, and the bears take control. Now let's game out 3 scenarios. Scenario A, bearish continuation, is our highest probability at around 40%. A hot CPI, for 0.2 or higher, lifts the dollar and yields. Gold breaks 43.13 and slides to 42.55, then 42.02. Below the 52-week average, you're looking at 41.14 and lower. Scenario B, a relief bounce, is about 35%. A soft CPI, at 4.0 or below, revives rate cut hopes and knocks the dollar back. Oversold gold reclaims 43.76, then 44.41, and squeezes toward 45.10. And if a geopolitical headline hits at the same time, that upside gets amplified fast. In scenario C, range and chop, is about 25%. If CPI lands roughly in line, near 4.1, with no clear catalyst, gold likely just churns between 43.13 and 44.41, waiting on Thursday's PPI and next week's Fed meeting for real direction. So here's the game plan. Trade the levels, not the noise. Watch the pivot at 43.13 to 19. Your upside triggers are 43.76, 44.41, and 45.10. Your downside triggers are 42.55, 42.02, the 52-week average, and 41.14. Let price confirm before you commit. That's your gold roadmap for the week. If this helped, hit like and subscribe to AS Gold for daily and weekly analysis. And remember, this is research and education only, not financial advice. Always do your own research and manage your risk. Trade safe, and I'll see you in the next one.